Welcome to Energetic Incorporated, Episode 1.
So back in the early 2000s, I was working at Sprott Asset Management, and I was extremely bullish on commodities in general and started poking around and digging into basically every minor little commodity I could find. And when I discovered the uranium story, I was fascinated. I thought it was super interesting, and I could see that it was coming out of a bear market. We subsequently invested a lot of money in uranium, did great things for our funds, made huge returns, and managed to exit most of those investments with 10 to 20 to some of them even 100 times our money on companies like Paladin last cycle. Then Fukushima came along, and that basically poured cold water on the entire sector. Everyone around the world basically put plans on hold, other than China, to stop building nuclear power plants. And then huge amount of shutdowns occurred, especially in Japan, which created this huge overhang for the uranium market because there was so much uranium that was contracted, and consumption dropped dramatically with these rapid shutdowns. And so from 2013 to 2020, it was just a bear market, and barely anyone could make money. Most companies went bankrupt. Most producers shut down. And there was really only a few survivors, and some of that production was coming from as a byproduct. So nuclear power, which is powered by uranium, accounts for about 11% of global electricity production. Accounts for, if you put it into the context of how many homes does that power based on average power consumption of homes, it'd be about 855 million homes, or close to, we're getting close to 1 billion homes for the entire year would be powered by nuclear power. There's really only a handful of traders of uranium in the world. It's such a small market. It's basically all over the counter, meaning that it's by appointment. It's literally phone rings, email, conference call. Let's try to figure out what price you're willing to sell at and what price someone else is willing to buy at, and let's try to match them up. The price reporting is sometimes done during the day, but typically it's at the end of the day. One trader could affect the global price by saying, I made a trade today at this price. So a couple of years ago, when I returned to uranium investing and was pretty excited about the price of uranium going up, I reached out to one of these traders, and it turns out he's one of the world's largest traders of uranium, and he lives in Greenwich, Connecticut. And get this, he was a volunteer firefighter. He won the state championship as a rugby coach for 10 years in a row. He's been a foster parent to many children, a guardian to others. He's just a really good guy, great community guy, and a connector of people, and one of the world's largest traders of uranium. And his name is Joe Kelly.
My name is Joe Kelly. I've been working in the uranium business for 15 years. We came up with a kind of a new concept which created transparency and liquidity to a marketplace that didn't otherwise supply that. Well, no, my role was always the intermediary. I always was the guy that focused on the liquidity, transparency, and the matching up buyers and sellers. They say somebody comes in with a bid or an interest to buy, they come to me because they were unable to buy really themselves, because a seller will want to get the highest price possible and a buyer will want to buy at the cheapest price possible. So a lot of times to call around and try to create that middle point for the transaction, sometimes you need an intermediary. It's basically you've got to trust the person who's creating the ability to buy and sell. Uranium lives in a tiny little world, and we have conferences once every quarter somewhere on the planet, and the 250 or so of us who actually participated in the market all meet up. So it's a very small incestuous market.
But 2020 changed everything. COVID, with all the concerns about supply chain, and the shutdowns that were occurring, were a real catalyst to get this market out of a bear market and start a bull market. They shut down production at many uranium facilities around the world. Many of the producers and mining companies shut down production, and they did not shut down nuclear plants. So you could start to see this balance shift where there was going to be consumption without production. And I thought that was enough of a catalyst to kind of kickstart the uranium market. And of course, the retail investor came surging in.
All of a sudden, it was a public market. It was in all the in X, Twitter was putting huge amounts of stories. Reddit was handling it. There was a bunch of people who were basically hyping the product, which brought a whole wave of buyers in. And those buyers came, and a lot of them came through the physical market, which we broker, and a lot of them came in the newly introduced SPUT, the ETF.
So along comes the Sprott Physical Uranium Trust, or SPUT for short. What we need to do is we need to understand that SPUT changed the market. They could issue shares and they could buy pounds. So this basically allows the retail investor to speculate on the price of uranium by buying pounds. The reason it's a game change on the market is the price was set by literally a few people, like arguably a couple of hundred at most could influence the price. Now, all of a sudden, you've got global markets, all the different retail investors, anyone with a brokerage account could influence the price of uranium.
So we had a wave of buyers. 50 or so million pounds were purchased, which is almost 40% of the world's consumption. 40% of the world's consumption was consumed by an ETF in a time when nobody buys or holds uranium.
You got to remember, this was around the time of stocks like GameStop and AMC getting, these super squeezes. And if, so you can see that the market had this propensity, this desire. There was these investors out there that liked to play the squeeze game. And if you were to look at this sector and analyze it and say, wow, if there's something that's going to be squeezed or could be squeezed profitably, this is the sector to play with. This is an amazing sector to play with, because you're not going to increase the supply of uranium overnight. It takes years to bring on new supply. And if you put the squeeze on utilities, they will pay just about anything for the price of uranium to keep their reactors running. For those watching this crazy little sector, you could see what was going to happen. And that's what got me super bullish on the price of uranium, that it was going to move and move dramatically.
Well, it was rumors of a shortage that might hit the market, which created higher pricing, but not quite as much as what it went up to $106 a pound. That was just a little expensive.
If we're going to just generalize about how this industry works, governments, major utilities around the world make decisions to invest billions and billions of dollars to build facilities. And then you have to depreciate or account for that cost over the life of the reactor, which is sometimes, some of these reactors can run 50 years plus, no problem. And so it's a long-term investment. There's an interest expense. There's upkeep on that equipment and refurbishing that has to occur every, there's schedules for different types of reactors. But the bulk of the cost, when you look at the power cost, the bulk, like 95%, say, or 90% at least of the total cost of power is the facility itself and maintaining the facility. The actual operating cost and the fuel cost becomes quite small. And when you break down the fuel cost into the, what does uranium make up of the fuel cost, it becomes even smaller. So it's really quite irrelevant. And once you've made the decision to build the facility, you'll pay basically whatever you need to pay for uranium.
And they kind of had a wake-up call with the $100 uranium and said, okay, let's make sure we get more mines in business and strike some contracts, some long-term contracts with some of the potential mines that could give us production for the next 10 or 15 years.
So it's basically what it is it's a battle between the bona fide buyers, the utilities wanting to keep the price low and nibble away at the market, and then the retail market saying, we think the price should be higher. So there's risks on both sides. And so basically what we have the whole market, right? Both the buyers and the sellers are looking at these long-term projections, right? You see different people producing, different organizations producing charts of this potential huge supply-demand gap when you start looking out 5-10 years. But the question is sort of who's going to act today? How are we going to behave today based on that long-term expectation? And it's not just the expectation of the supply gap and how it's going to be filled, but how much does the price need to go up to spur that gap to get filled? And what is our collective views? What do the producers think about their true costs, what their costs are going to be?
There is enough supply. We can always find uranium for people who need it, and there was enough supply to meet the needs, but not as much as there once was. So that's why it's settling in here at $60-something rather than being stuck with an oversupply of uranium at $20-something.
Let's go back to the overall dynamic. So I'm trying to explain the dynamic of this market so that we get a real clear picture of what's going on. And the way I see it is we have this retail vehicle that can set the price of uranium as high as they want. When there's inflows and optimism, the market's going to put a squeeze on the price of uranium and take it up to whether it's 100 plus again or $200 a pound or beyond. Now, then there's the utilities. They're looking ahead and they're reading all the different production forecasts. They're following some of the big mining projects and trying to estimate what is supply and demand going to look like 5-10 years from now. And as they start viewing that it's going to be very difficult to contract a lot of pounds in the future, if they start having that view, they will get more aggressive in the spot market today, and they will also get more aggressive in contracting. And if the more aggressive they all get in long-term contracting, the less available pounds are going to be in the long-term market. Literally, the big producers will sell out and be like, I don't have any more long-term pounds to offer that nobody wants to contract pounds that they're not sure they can produce, because they end up getting squeezed themselves, which we've already seen in a couple of the producers out here. These new early producers that have stepped into the market and have contracted to sell pounds are finding that they're having trouble producing the pounds. And now they've got to enter the market to buy those pounds and potentially risk having to buy them at a higher price than they agreed to sell them for. Are they willing to contract 5 or 10 years out at a set price with a floor price or a cap ceiling? I mean, I don't know why you would in this environment. I don't know why you would, give that upside away to a utility. I wouldn't do it because I see massive risk. And I've often argued, if anything, I think producers should be starting to look at the power price and using that as an indicator and saying, look, if the power price is X, we want to get a certain piece of that power price for our participation in nuclear power.
And what we're seeing is basically the market's looking for equilibrium. It's trying to find out where it should trade. It's trying to find out where production can make enough money to produce enough uranium to fulfill the needs of the consumer. And is it $60-something? Well, it's testing the market to see. So we're at a test mode right now. Is it $70? It might very well be, but we're finding there's an extended period of time now. We're sitting at these 60, 65. Well, not quite 60, but 62, 63, went back up to 65. Will it go back up to 70? Will it break that mark? Well, it very well might, but the point is that it's trying to find equilibrium at this point, and that's what it's testing right now.
What do we see? We see guys like Joe saying, well, is it going to be, 60 low? He used the number 70, right? He says, 70, yeah, it could be. Is it going to go break out there? Without making an actual forecast of where it's going. He's not talking about 50s. He's got a bias for it moving up. I've got a bias for it moving up. He said that 100 was a little bit expensive. Yeah, it was a little bit expensive. But really, nobody cares. The utilities don't care about $100 a pound. They will pay it when they have to pay it. So what really matters is, what price do we think it's going to be? The retail investor, the average guy, what's the long-term forecast?
So where is it going to be? We're narrowing that range. It seems for the last 6 years that people have been saying, well, 2 years from now, there's going to be a major shortage. Well, we're certainly well into that 2 years. So I don't know if there's going to be a shortage. If there is, the price will go up. But it seems like there's enough supply for the needs of the world's nuclear power plants at this point.
So a major catalyst going forward is going to be the rise of government inventories. Governments deciding that for national security reasons and to protect their economies and protect their power grid, they should be building inventories. The U.S. Department of Energy has put aside $2.7 billion to begin building a stockpile of fuel for the new generation of nuclear reactors, the SMRs, or small modular nuclear reactors.
The DOE has put the $2.7 billion to create something of a fuel bank, or at least understanding how they can create fuel in order to encourage this new industry of modular reactors. I mean, it sounds very cool. They run submarines and aircraft carriers on small little reactors, and submarines, the nuclear submarines, they run on those small little reactors for the life of the submarine. So it sounds like cool technology. No one's, I believe, it was on 60 Minutes, I believe, the other night, and they talked about how it really sounds exciting, but no one's built one yet.
China is already in the lead in terms of building new nuclear plants at a greater pace than anyone else on the planet. And if anything, it looks like that's going to pick up pace. The new reactor technology, these small modular nuclear reactors, could be rolled out extremely quickly and even be put in place to replace coal plants. And the fact that small modular nuclear reactors get produced in factories and literally can be shipped around the country on the back of an 18-wheeler, the speed at which they could decide to step up and roll out nuclear power is unprecedented. Compared to any other country in the world. And when we see what they're doing in terms of electric vehicles with BYD, with their new 5-minute battery charge that can do hundreds of kilometers of range. It's no doubt in my mind that China is going to be leading the way on nuclear power in the future.
But right now, there's a few companies who are looking in this space right now. And my fear, and many asked me about it, and I said, it sounds like very cool technology. I'd be concerned or worried that investing in one or two of these, or any specific one of them, might be a concerning or risky investment, because maybe one or two of them will succeed, but there's a half dozen of them, maybe a dozen of them out there that are priced as if they're going to succeed.
What I find really interesting is to consider the total power that is released from the burning of hydrocarbons, that being coal, natural gas, diesel, gasoline, you name it, all the hydrocarbons. When you add it all up, you're going to come up with a number around 140,000 terawatts of power in terms of, if you're to put it in terms of electricity. And that compares to around 3,000 terawatts of nuclear power. So it means nuclear power really only provides about 2% of our total power use in relation to the total power use from hydrocarbons. So how are we going to materially make a dent in this hydrocarbon power production? We have to multiply things like nuclear and solar and wind and everything if we really want to actually make a dent. Like, the real numbers are not really looked at nearly enough, because we keep using more hydrocarbons every single year, and we're not offsetting really anything. And in terms of total power consumption, 81% of all power that is produced is hydrocarbon power. I mean, the world runs on hydrocarbons, and we got to stop pretending that it doesn't, and we have to get realistic about how we're going to actually make a dent in it. And so, is it, I used to say there's going to be a 6-fold increase in nuclear power over the next 10 to 20 to 30 years. It really should be, if you wanted to set off all the hydrocarbons, it would be a 46 multiple. That's not going to happen. But is it going to be 10 times? Are we going to grow the fleet of nuclear powers 10 times globally? We should, and we should do it as soon as possible. And what does that equate to uranium demand? What should the price of uranium be in this high growth scenario that I believe is coming? We're in a bull market. So my take is we're in a bull market. That's pretty obvious. There's often corrections in every bull market, in every single commodity. There's these 50% corrections that we see from time to time. So my long-term forecast remains the same thing it did at the start of the bull market. Is we're going to have this massive bull market in uranium. We're going to see prices rise at times, potentially hitting $200 a pound or exceeding it, because of the new dynamic that Spoot has of this ATM ability, and things can get crazy.
So I'm really excited about the nuclear industry in general. It's favorable politically here in America. You have certainly the Democrats and the Republicans at the opposite side of most arguments. They're not at the opposite side of this argument. They might like it for different reasons, but they certainly are unified in supporting this. The Globe seems to see it as a great way of producing reliable, steady electricity, carbon-free, and whether you're believe in global warming or not, basically, or climate change, I guess it's changed too, but basically it's a good form of electricity, safe, reliable, and there's no shortage of fuel going forward. I mean, I've heard many discussions on it's really if all the electricity was generated in the world for the next 300 years or 3,000 years, some crazy number like that, we wouldn't run out of uranium. There's plenty of it.
So given where we are today, we've seen this pullback. We see terrible sentiment. I think prices are moving higher. I think the sentiment's going to improve from here. I think the retail community will put money back into Spoot, and I think other ETFs will also feed it as people decide to basket buy a collection of beaten up potential uranium producers, whether you're going for the stock ETFs that focus on the juniors or they focus on the seniors. These other ETFs also own Spoot. And so when people pour money into those ETFs, it automatically buys Spoot as well. And once it returns to premium, it's going to take the price higher. How does sentiment improve with price? We see it over and over again. As the price moves up, sentiment improves, causes more flows. People want to see confirmation that we're still in a bull market, that prices are rising, and that's what's going to happen. And yes, will there be more problems? Of course there will be. We've seen a problem with Paladin. We're going to see other mining problems. We're going to see delays. We're going to see cost overruns. We're going to see some producers actually have to enter the market and buy pounds in order to deliver into their contracts. And all of this is going to lead to more uncertainty about the price, more demand to try to contract, and there's less and less pounds available in those outer years. And the more we all start looking bullishly at the future and seeing these new builds, restarts, they're now talking about potential restarts and a return to nuclear power for Germany. As these things play out, the sentiment's going to improve, the price is going to rise. Producers hopefully will step back and say, I don't want to contract at I want a higher floor and I want higher ceilings because I'm concerned about rising costs and my ability to produce profitably. And all of this combines to a sentiment change for the utility, the fuel buyer, to say we need to step up and we should secure more pounds. And that big moment in the cycle comes when all the utilities, all the fuel buyers are all out there trying to secure long-term contracts to tie up pounds for the next 5 and 10 years. That's the big driver that's going to really set this market on fire. And yeah, is it coming in 6 months or is it coming in the next couple years? It's very hard to tell. But as sentiment improves and capital flows into the stocks, especially into SPOOT, we're going to see that market get lit on fire, and we're going to have it feedback higher and higher. It's like a co-vitality spiral for the uranium sector. Well, thanks very much for tuning in. This was my first podcast. And just to be clear, although I'm known somewhat for uranium, I'm a resource bull in general. I'm a bear on fiat currencies. I'm a bear right now on tech stocks, but not on technology. I love technology. I'm going to be covering some of the latest developments and trying to look for value in all these spaces. And I hope you follow along. So click like and subscribe if you're interested in following me more. And I hope you enjoyed it. Thank you.